We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodricks. Joining me today is Michael Oliver from Momentum Structural Analysis. How are you today, Michael?
I'm just fine, Tom. How are you?
Excellent. Great to have you back and have your very seasoned look at the markets as always. So every time we speak, Michael, you remind us that price can lie, but momentum is what tells the real story. So maybe we could start by you giving us a little bit of an example of where this is evident right now and where price might not be showing the true story as you see it.
Well, there's that one asset category that we think is it's always been pivotal, but right now people aren't too worried about it. Some asset managers are simply on risk reward issues, but that's the stock market, especially the U.S. stock market, which is the biggest bubble in U.S. stock market history. Just take a chart of the S&P, go back to 2009, throw it up on your wall, and when they say there's not been any inflation over the last decade, say, oh yeah. There's been monetary expansion, and instead of it going into commodities, went into stocks. Okay. Now, since the Fed has been in their aggressive policy for the last year or so, the stock market after the March low, let's say starting last summer especially, was nothing but a positive for them. It wasn't a negative cloud overhanging sentiment, public spending, corporate spending. It was a positive. So the Fed didn't have to sweat that issue. And it's an issue they sweat because Bernanke, I always say this in my interviews, wrote a paper in 2003, you can go find it online, where he defended the notion of the stock market must be defended. And the reason is it stimulates consumer spending if it's up there, even if they're not in the stock market. Their sentiment is buoyed by a strong stock market. Because even people who work in factories know that if there's a big stock market decline, they know what happened the last time. They got laid off. So they pay attention to the stock market too, but it's not been a problem for the Fed. Okay. What if all of a sudden the stock market becomes a talking point again on the downside? And I don't mean a crash. I mean a normal bear market begins. And if you go back and study the last 100 years, you'll find that normally bear markets don't begin with crashes, only one exception, 1929. Mm-hmm. They begin with arm wrestling matches. 2007 top, heck, it didn't really get underway till late 2008 in everybody's mind, but yet it topped in 7. 2000 top, didn't collapse in 2000. It made an arduous top, worked its way down, was wiped out by 2002. No crashes. Okay. We don't expect that. We think the stock market, especially the stock market, is in a topping process right now. We have some initial evidence of that. It occurred last month. And in fact, it was in our last weekend report. You see the charts here, where if you look at the price chart of the S&P, which is what you mentioned, it looks good. There's just an upward tube. It's a very tight little parallel channel tube going back to last October. And there's nothing in that price tube that looks bad. You're still in the tube. Okay. There's one subtlety about that price chart, though. If you look at the highs that occurred within that zigzag tube, that parallel channel, they all bumped the top of the channel before they turned down. Mm-hmm. This time, the new highs in the market on price are not anywhere but near the mid-channel. They're not bumping the top of the channel, meaning they're not as strong as they used to be getting up to channel top. So that's a hint, price hint, but they're still up. When you look at the chart below, what it shows is each daily close of the S&P 500 plotted in its percent relationship to how much above or how much below the 3/4 moving average. The 3/4 moving average changes every quarter. You average the prior 3 quarters, come up with a new number. It's roughly about the same duration as the 200-day average, which changes every day. The only difference is 3/4 only changes once every quarter. Mm-hmm. Well, if you look at what happened from January through the end of the second quarter, 6 months, it was horizontal bumps on a floor on that momentum chart. So you could see a structure there, like what price chart guys like to find. A nice floor that if you break it, you got a problem. Well, momentum broke the floor. And the entire rally that we've had over since late last month and into early this month, which has been a gentle little thing, really, is bumped the underneath side of that floor. And we suspect it's going to stay confined probably below that floor. But momentum is broken. Okay. Now, what it suggests to us now is, okay, you want to look at price, it's time to look at it. Because if momentum broke, price will usually follow not soon, not too long thereafter. Watch the bottom of that price channel. It comes through around 4,300. In fact, you don't want to go to 4,300 on the S&P. And, we've been trading either side of 4,400 for the last several weeks. So it wouldn't take but a 2 or 3% sneeze, and you're hitting that line. And if you break that price channel, that'll be further evidence validating what momentum has already said that, I'm beginning to break down. The big guy to watch is not the S&P. We know that this market leadership has been exceptionally narrow, narrower than it's ever been in market history. Many analysts have pointed that out. You can, it's Microsoft, Amazon, Apple, Google, et cetera, constitute like 40% of the front end weighting of the NASDAQ 100. So your leadership symbols, and they're about 20% of the S&P 500. So that's where your leadership has been. It's driven the market up. A lot more stocks now are not making new highs than are making new highs. In fact, there are a lot more making new lows than are making new highs. But anyway, we're focused on the leadership, and that's represented by NASDAQ 100. It has an annual momentum situation. Now, annual momentum is a step up in terms of time scale compared to what I showed you with the quarterly momentum of the S&P. They're both long-term metrics. So if you break them, you change those trends, it's usually a long-term implication. But on NASDAQ, it made a deep low in the 2009 sell-off. It dropped 40% below its 36-month average. It's pretty deep. Okay, it really, if you like a yo-yo, it went deep. All the rally highs that NASDAQ produced in the 10 years following that all went up to 40% plus, 41 to 42% over the 36-month average, and peaked and came back down a bit, went back up there again, and they defined a perfect horizontal range. You don't see it on a price chart. Mm-hmm. Price chart's a powerful up move with almost an upward arc. You can hardly even draw a trend line on the price chart. But momentum has this perfectly flat little box, and you lift it off. The rocket last summer went through the top of the box. Mm-hmm. So that ceiling at high oscillator levels, 40+% over the 36-month average, which changes every month, rises. And it's lived above that top of that box since then. So for a year now, you pop through it on the blow-off move last summer in the NASDAQ. When the NASDAQ didn't go up, it went up vertically. Okay, the leadership took off. It's since dropped back down toward the top of that box 2 or 3 times and held the top of the box. So our eyes are focused now. The next signal we want to see to confirm that, in fact, the stock market is topping, it's over, is for the leadership to crack back through that launch point, drop back down to 40% over the 36-month average and abort, what we call an abort, where it breaks through and then comes back down through the upper ceiling. At that point, we go full bear. And we think that's going to happen. We think this gentle bouncing on top of that box is not going to last much longer, especially now that the S&P has already given us a hint. Okay, so that's what we're watching next, and we publish those month numbers every month because they adjust every month. Okay, now what if that breaks? What are the implications for gold and silver? Well,
Michael, before we get to the implications for gold and silver, I just want to go over a couple things with you there, if you don't mind. Okay. You were talking about this narrowness of the, let's say, the leadership of the stocks in the NASDAQ, especially. This is, more signs of a real bubble, is it not? This fact that there's this, concentration of wealth, or let's say speculative capital, in these narrow bunch of companies.
Yes, absolutely. A lot of people recognize that, but that's been true for a while now. So it's been true at least since last summer, when the NASDAQ lifted off and left the other indexes behind. Mm-hmm. Now, but since then, a subtle thing has happened. NASDAQ performance is not continued. The market's gone higher, but NASDAQ relative performance to the S&P is actually lower than it was back early this year. Mm-hmm. So even though it's hanging in there, and the S&P make a new high, Dow make a new high, NASDAQ 100 make a marginal new high, its relative performance when you plot it on a spread basis is actually deteriorated. Right. So your leadership is still up there in terms of the superficial price veneer. They're beating their chest. Oh, look at me. But on a spread basis, they've actually lost relative performance value. And that's usually a hint. In fact, that happened at the 2000 .com top, tech top. NASDAQ 100 was the leader then too. Its spread broke down versus the S&P in April of 2000 after making a high in March, NASDAQ 100. S&P continued to hold steady and actually went up, made a new high monthly close in August of 2000. But that spread of the leadership had already turned down in April. So like 6 or so months later, S&P was still hanging around like, look at me, I'm fine. But the spread said, no, you've begun to lose your leadership. And sure enough, after that August high in the S&P, it was a drop into October, and then the bear market finally, unleashed. But that spread was a good leadership indicator of failure of leadership. And we've already had that technical indication from the NASDAQ 100 on a spread basis. So, and there's another thing that people watch also, it's the volatility. Mm-hmm. We were talking before the interview, volatility isn't a metric that a lot of people are focused on now. And they use the usually option-based methods of determining the volatility of S&P and other markets. Very popular to look at. And those are at very low levels. And so, there are levels where you got to be suspicious. Well, we have our own version of volatility measurement. It's proprietary, but it's based on the standard deviation bands, upper and lower band around momentum readings, not around price. Mm-hmm. And those volatility readings for the NASDAQ 100 have dropped to the kind of levels and have been there for 2-3 months now at these very low levels. And usually when you get to those low levels in the volatility, our bands are constricting on the momentum because the volatility of momentum is shrunk. We were there in the summer of 2008. And if you look at what happened in 2008 after August, I think it was August, you got the very low levels. October, November, December of 2008, S&P dropped 20%. Pretty big drop. And in fact, it was 6 weeks of those 2 months. Mm-hmm. But the volatility metric said, watch out. And sure enough, what didn't take too long. Also happened prior to the March drop last year. Volatility metrics in late 2019 screamed, so you're about to get volatility. Mm-hmm. We're at that same position again. But it's one of those metrics that I call a wet noodle. And you push it across a table and it's not like a dry noodle that moves something. It's a wet noodle. Mm-hmm. So you pay attention to it, but it's not a perfect timing metric. Mm-hmm. But the fact that the S&P broke its quarterly momentum last month, that makes it a little more pregnant situation. Mm-hmm. And so our eyes are focused now on, one, we know the volatility is ripe for mm-hmm. increased volatility soon. We know the S&P broke its leg last month, though you can't see it on the price chart yet. Get to 4,300, you can. And we know the NASDAQ has a structural level below it that's not very far below, that if you break it, it's topped. Mm-hmm. So a lot of pieces.
Yeah. I know you did an interview recently with Patrick Karim and Kevin Wadsworth over at North Star Bad Charts, right? And they talk about the weight of evidence. So this is just adding to our weight of evidence, right? So if these equity markets have found their top, Michael, what type of downward path do you think that they're going to take? Is it going to be sharp and contracted, or is it going to be a long, drawn out process? And
I think it'll be layered.
Have we seen this real blow off top that some analysts have been talking about?
I think we've seen the blow off, and I think that was primarily evident in the NASDAQ 100 mm-hmm. and those symbols I mentioned, where you didn't go up at this angle, you went up that straight up. Okay, you've not gone straight up anymore. Mm-hmm. You're crawling now. Okay, so the blow off phase we think is over, and we think now it's just a matter of. Do you remember Pac-Man, the little biting guy? Okay, well, coming up from below are these momentum numbers. They're like Pac-Man, and their teeth are opening and closing. And so as the market sort of stalls, even though it continues to nudge a new high, these numbers, these momentum breakage numbers are rising. They're rising because the 3-quarter moving averages are rising. They're rising because the 36-month average is rising. And the structures that you break on momentum are rising accordingly with the rise in those moving averages. So as the market stays up here, the averages are catching up to it. And so are these structures on momentum that can break down. So a lot of stuff is closing in on the market and it doesn't know it. And I don't think the Fed knows it. Mm-hmm. It's a variable that if Powell hasn't talked about the stock market, in any of his recent meetings, he's not talked about the stock market because he's not been concerned by it. But what if all of a sudden we get a 5 or 10% initial drop in the S&P and the NASDAQ will go a little more? It'll lead on the downside as well. But no, we're not looking for a crash. Mm. We're looking for a normal, arduous bear market, which may include, 10 and so percent drops here and there with rallies and then more, et cetera. Just go back and look at the 2000 to 2002 bear and the 2007 to 2009 bear. Look at how they unfolded. There wasn't a crash, especially at the beginning. There was no crash. Crash being 35% in several weeks, like 87 or 29, or March of last year. But no, we don't expect that. So that the panic effect of margin calls and, everybody selling everything type of thing, we don't think that's going to unfold.
So, Michael, as you mentioned, if these markets start to roll over, won't Powell try to come in and help the markets really maintain these levels and try and prop them up? Or is the Fed out of, effective tools now?
Well, they certainly won't change. In other words, all this talk of them tapering, that'll go out the window if stock market becomes a variable or even a potential variable. Even drops 5 or 10% from its high, they're going to pay attention. So are investors. So is Wall Street. So is the average guy on the street, because he now knows that market, if it drops 10%, I might get laid off. This is like 2007 again. So the Fed will be very sensitive about that, even though they have not mentioned it whatsoever, I don't think, in the last months of meetings. I don't think it's been in their notes. And if it suddenly becomes a variable, then all this talk about the Fed changing policy, that goes out the window immediately. So that's something in a side mirror that if you're in the gold and silver markets, watch the gold and silver. And as far as we're concerned, they're behaving well. But that stock market's a variable that will definitely keep the central banks fully on course, if not more aggressive. Mm-hmm.
So in your opinion, though, are their tools becoming far less effective, and are they going to be able to really push the market any higher from here?
No, I don't think so. I think, again, it's they create the river flow. Mm-hmm. And basically, this has been true since 1959. Every decade since 59, M2 growth has approached doubling. It's usually been in the 90 some odd percent range. Mm-hmm. So you take money growth doubles every decade. Do it on a chart. It's pretty scary. What's happened over the last year is off the page. Mm-hmm. It's like a blow-off. And it's paused recently, but it's a massive amount of monetary expansion over the last 12 months. And it's not just us. It's the ECB as well. They're on course for that. So you give them another excuse, like a wobbly stock market, especially the U.S. stock market. Mm-hmm. And they're not going to stop. And if they try to, he's not going to be the head of the Fed in February. Mm-hmm. Okay. And there's some debate about that too, because you look at the front page of the Journal today, the progressives around Biden are saying, hey, Powell hasn't done enough to regulate the banks, come down on the banks. So they're trying to come up with arguments to unseat him.
And maybe before that time?
Well, no, at that time. So they're setting the stage for, let's replace him with somebody you pick. Okay. Mm-hmm. And you can bet whoever Biden would pick is not going to be, a hard money guy. Okay. Mm-hmm. So it's going to be a continuation, if not extension, of what Powell is. Mm-hmm. So either way, it's going to continue. There's other variables out there too. There's socioeconomic type things that we pay attention to. We've mentioned, as far as summer of 2019, we were mentioning before the virus even hit, because we anticipated that market drop. In fact, we predicted it would be a crash, not a normal drop. And these are social. Well, right now, the eviction thing. Okay, now we had riots, over the last year based on police incidents. You can understand that. Okay, people were upset. They took to the streets. Now you suddenly have millions of people who might be evicted. And many of these people weren't evicted ever in their life before. It's not like they're lazy bums, okay? It's the first time in their life they've ever had this happen. The shutdown knocked them out of a job. They got behind, et cetera, et cetera. And now suddenly the poor landlord who's hurting too. is not making his payments. Mm-hmm. So all of a sudden, what I've heard numbers from 6 million to 10 million, whatever, families. What happens if that turns into something disorderly? Mm-hmm. Panic. All of a sudden, Powell has mentioned this, not that specific issue, the evictions, but equality issue, where the Fed is now, that is part of their policy. Well, this is going to raise that issue again if we start to see rumblings from this. And, it wouldn't surprise me. I'm not predicting it, but it wouldn't shock me. And if that suddenly becomes on the horizon, then there's a whole new factor. You think Powell's going to tighten in that environment? Okay. So all this talk that has, for instance, caused gold to have a bad 3-day sell-off in mid-June, which basically ended then. It extended another week or two, and now we're well back above that level. But is based on a headline chasers who believe that reality is going to happen. Mm-hmm. We don't think it's going to happen. There's too many other variables out there that could cause new talk that ends that debate entirely.
There's too much other pressures in that same direction of not tightening and never right. Getting away.
That haven't even been brought up. Yeah, that haven't even been brought up into the discussion yet, but could suddenly pop up. We'll see.
Well, it seems kind of like the discussion, recently as well about the debt ceiling and they missed the deadline, and it's the 2-year. Let's not think about the debt ceiling for 2 years, but there's no way they're going to let that.
They never have
actually expire. Yeah, exactly.
They've never have in history. And pardon me, I'm going to upset some Trump/Republicans when I say this, but look at the debt growth under Trump. Okay. It's off the page. So for the Republicans to suddenly swing and say, no, we can't do this anymore, it's bad. Well, why didn't you say that in the last 4 years? Okay. Anyway, and that's another variable. And again, people get mad when I say this, but Barry Goldwater and Ronald Reagan were orthodox, basically conservatives, founding father type conservatives, limited government. They weren't personality people. Mm-hmm. They didn't believe in person. They believed in concepts. Okay. And those are the two standout Republicans over, the last 50, 60 years that shaped the Republican Party into what it used to be, namely a conservative, limited government, pro-capitalist party. Despite that fact, statism grew all during those years. Even under Republicans, it grew. The government grew. Okay. What's going to happen to the 2022 election? Everybody thinks, the Republicans, we're going to take over the House again. Okay. Well, if you go back and look at the the results after the 2020 election, in congressional districts where find the number of Republicans who won by 5 or 10% in their district, not 20 or 30, but 5 or 10. And factor this into it. There's a hardcore of the Republican Party that is old-fashioned, conservative, non-personality oriented. They don't like Trump personally, especially after they voted for him in 2020 election. But after the events in January, they're out of it. And even some that are in office now that we know about, who are headline Republicans who are booed by their party members. I've seen statistics that maybe the old hardcore of the party, the real conservatives, the non-personality cult people, might be 20% of that party. If they sit on their hands in the next election, no, they don't go vote Democrat, but they just don't vote for that guy that's running who is a hardcore Trumper. They just don't show up. Mm-hmm. Then how many of these congressmen that barely won by 10% or 15%, if you take about 10 or 20% out of their vote, it just isn't going to show up this year because they're a Trumper. What's going to happen to the 2022 off-year elections? It could be more of a shift toward the Democrat Party. Mm-hmm. And the GOP could find itself totally broken at that point. There's already been talk of forming another party. So that's another variable out there in the side mirror that could change all the discussion. And it may be already set in place because of what's already happened based on the anti-Trump people saying, I'm out of this. Mm-hmm. I got a picture of Barry Goldwater in my hallway, not Trump. That party could be already permanently damaged. And we'll find out in the 2022. I'm not going to predict, but I'm just saying, look at the number of congressmen who barely won or won by the kind of margin they could lose if 20% of their party says, I'm not interested.
Mm-hmm. Yeah, that's an interesting point you bring up, Michael. So as we were going to get to, how are gold and silver behaving right now? Have we seen this real sideways consolidation? Is momentum starting to show something different than this silly price, this silly, frustrating price action that we've witnessed here for the last couple of months?
Well, it's our view that the March low in gold, which was about 9-10 months to go down 20%. Okay, as I just mentioned, S&P broke 20% in 6 weeks in late 2018, and yet nobody was screaming major top. Mm-hmm. Okay, the gold guys get bearish as soon as it sneezes. Okay, but it took 10 months to pull back 20% from top to bottom. Mm-hmm. 2050 high close to a 1673 low. Then we popped up to 1900. Then the Fed news came out, knocked us. We were about 1860, knocked us down to about 1750. Did not go back to the March low. And then we pop back over 1800 again, where for the last 4 or 5 weeks, that's where it's been closing. Okay. So it's almost fully offset where the Fed announcement came. We were trading around 1860 on the August contract when that Fed statement came out. And all of a sudden, we had this huge drop. It was at late Wednesday, Thursday, and into Friday of that week, mid-June. Silver continued down a bit after that, had a sharp drop, but continued lower. So did the gold miners. But we think we've probably seen the low in both of those components of the gold-silver complex. Gold already saw its low, we think, in mid-July, and has now popped back up. Now, if you look at a price chart of gold, you see this now sort of in the middle of the range of the last 12 months. I mean, you're $150 off the recent low, you're $150, $200 off the high, so you're sort of in the middle of the range. So it's sort of confusing. When you look at the momentum chart, what it shows is weekly action of gold measured versus that same 3-quarter moving average we used to measure the S&P, except here we're using weekly bars. We've plotted a line, what we call a structure. It goes back to March of 2020, where there was a low weekly close on that oscillator. We pointed an arrow at it. Mm-hmm. And then in November last year, we had another gold sell-off, and its low weekly close was at the same level. It turned back up. And then in January this year, it broke below that level. And that's when we announced gold was like 1870 at that time. We announced, gold's going to go for another leg down. Probably the final leg, but it's going down some. Well, it went to it dropped another couple $100. That momentum chart, shortly after breaking that support structure, that low that occurred in March 2020 and November 2020, broke it. You see it on the oscillator. It rallied back up and bumped the underside of that floor, bumped its head on it. Couldn't get through it. So it defined that level as pivotal and then dropped again into March. Then you had your rally in May. Gold got back up over 1900, but that momentum chart went up where? Precisely to that horizontal line. And it failed there. It rolled over from that line. That line is now a 4-point horizontal line. 2 floors, 2 ceilings. Perfect. Going forward, if we see a weekly close during this quarter, the number won't change, just above 1865. But we've been up to 1835 in the recent rally. But you get to 1865, it's a couple percent above where you're trading right now, and close a week there. I'm going to close over that line. At that point, we're going to announce gold is ready to launch out of this range. Now, when you look at the price chart, that doesn't mean too much. Mm-hmm. The last 2 major rally highs were above 1900. So getting to 1865, what you've done there is you've gotten back actually to the price level where gold was when the Fed made its statement in June. Okay. But for that momentum chart, it says, okay, not only have I broken out of this parallel channel that it already broke out of, so it's already positive in that regard. It's taken out this ceiling. So at that point, we think gold's ready to come out of this zone that it's been in for a year plus. Now, when we go to silver, we measure it versus a similar metric. It's long-term, 40-week average. It's about the same as the 200-day line in terms of duration. It's about the same as a 3-quarter average in duration. Silver has been living on that momentum chart. Price has been in a range, sideways. So we're in the middle half or slightly upper middle half of that price range. So when you look at silver's price weekly, it's really been in a horizontal zone, not been going down, just up and down. But momentum has been correcting from extremely overbought levels last summer down to more neutral levels around the 40-week average itself. Doesn't matter whether you're above or below, but down in that area is sort of what you call neutral. But in the process, over the last 10 months, it's developed a tube, a perfect parallel channel that you can see on momentum. You can't see it on the price chart. And we pointed out with circles the weekly closes that define the top of that parallel channel. There's like 5 of them that all line up perfectly. So it developed what we call momentum structure. For this week, the breakout number is 2722. Yeah, you won't see it this week, but that number gets lower each week, partly because that channel continues to decline. And so if we see silver get up, much above 27, probably anytime this month on a weekly close, it's probably out of here. And again, we're referencing the gold chart at the same time that silver chart. So if those two guys break over the quarterly structure on gold, the 40-week on silver, we're going to announce, okay, this congestion zone we've had for these two metals for the last year, it's gone. Mm-hmm. We're back in gear. Doesn't take a lot.
And that, based on those two things, Michael, you're saying that could prove to be a very, in a way, violent upside move for both the metals. And I've heard you say in the past little bit here that silver could be the next Bitcoin, right?
I think it could be, and I think it will be. You come out of those two structures that I just defined on the gold quarterly and the silver 40-week, and I think they'll probably be pretty coincident because they're about the same dynamics above us to get there. It's not that big of a deal. And also, neither of them make sense on a price chart, which is good. I don't want the price guys know when it's ready to launch. They'll know when you get up about 30 again, then they'll realize, oh, it's coming out of here. Mm-hmm. We're saying just above 27 is the number. But if they engage those structures, that should be potent enough to change not only the direction from sideways silver to up, or gold now sideways to up, but the tone and the speed. It's much like when silver broke out we had an annual momentum breakout on silver over a flat ceiling that occurred in July of 2020. Price was at $19.40. If you looked at a price chart then, it wasn't breaking out over its recent highs. It had been higher a couple times over the prior years than that price. Mm-hmm. But in July last year, when it hit that, it went up 50% in 3 weeks. That's what I mean by a tonal change. Mm-hmm. And so we think these structures that are pending right overhead in silver and gold are likely to be engaged. And one reason we think they're likely to be engaged is usually when momentum builds a structure, it does it with a purpose. In other words, it doesn't build something to just wave goodbye to it. It builds the structure as a starting gate for the next move. Mm-hmm. Inverse to what the S&P did. It held the floor for 6 months. Well, it built the structure on quarterly momentum with intent to do what? To break it. And so I think the same situation in reverse is now set up for gold and silver.
So, Michael, what is the momentum that is going to come into gold and silver, or the monetary metals as you accurately refer to them? Is it based on trading algorithms swapping over into this, or is it institutional buyers coming back into the market? What kind of, let's say, capital is going to start flowing to really push this move?
Non-gold bug money. Gold bug money is scared money. It almost tends to be that historically. And while they may be early and nervous, larger capital flows in. We know that the gold mining sector is a small sector dollar-wise, compared to the health care sector or anything else. It's trivial. So it doesn't take a lot of investor preference shift, which is what you're looking at. We're looking at people who are not gold bugs, who may not be in gold yet, or may be in only a small percent of what they might otherwise allocate. Mentally, they're ready to do more. Mm-hmm. They're not intellectually against it. They just want more evidence and want more wind at their back. They want to see gold go up some, But Ray Dalio made the statement 4 or 5 months ago that investors should be concerned about not the price of their stock, but the underlying value of their money. Mm-hmm. Meaning it's being inflated, guys. Don't you see it? Okay. So even he was not a gold bug, and there's others, Druckenmiller, mm-hmm. Who are looking favorably on these categories. And as the stock market wobbles and creates more sense of risk, they're not necessarily over bearishness, but just risk where we need to move some money over to this category. Why? Because it is behaving better, and that's what'll get behind those markets, because they're relatively small and it won't take a lot of investor preference shift to change their tone and speed up angle of direction. It won't take much.
So are the gold and silver miners movements right now starting to signal this possible breakout of the metals,
Yeah.
Michael?
Yeah, well, GDX is a good example. It made a low along with gold in mid-June, but it continued down. And the week prior to its low week, we thought that low week would probably go down and close around the low 33 level, and that's what it did. It dropped slightly under 33, and it produced daily closes all that week at the low 33s. And then within 2 days, late last week, it offset 6 weeks of price action. Which you could go back 6 weeks and find all the selling pressure that was marginal price decline at that point on. It was following the June break. GDX continued down, but within 2 days late last week, it offset all of that price action with a thunderbolt upside. And we're now there, above 35, for example, which puts you above like 6 weeks of prior price action. And it did it like a light switch, meaning all these guys who were selling were offset within days. So they have to decide quickly, do I get back in or what, But in the process of doing that, the gold miners, GDX, GDXJ, SIL, the silver miners ETF, all broke out on their weekly momentum. Now that's not real long-term. That's measuring like versus a 3-week average, that type of thing, as opposed to a 3/4. So it's more short-term, but they turned up. So that aspect is turned up. But now what you should watch is the behavior, those two charts I showed you, the gold momentum and the silver. Those numbers are not far above us. And at this point, if I were in the gold stocks, I frankly would pay attention to the gold and the silver charts. Because when those two charts engage, be assured the miners will snap back and go into a leadership role again in terms of percent gain. It's the way they always behave. They're weaker on the downside, they're stronger on the upside.
So, Michael, can I ask what type of, let's say, this violent upside move for gold and silver, what do you expect to see out of these moves for, let's say, the next 2 years? I know putting a timeline on things is difficult.
That's okay.
But
That's okay. I think it's going to be more of a chaos theory type advance, not an incremental advance. Gold's been an incremental advance since 2015. It's had $100 surges here and there, but it's not had a parabolic thing like silver did last summer. It went up 50% in 3 weeks. We think silver will lead the move on a percent basis, big time. It will beat gold, but watch gold though, because it's the mama. Gold bull markets since the 1970s, going back 50 years, almost all of them were 7.5 to 8-fold moves in price. The early 70s to the 75 bull, the low in 1976 to 1980, the low in 2000 through 2011, they were all 8-fold moves. Well, where was the last bear market low in gold? 1054. Okay, 8 times. Okay, if it just duplicated those 3 prior moves, it'd be at $8,000. And that's to say, just duplicate, not anything special. And this is all reflecting, again, ongoing monetary expansion, the number of money units that exist on the planet, especially in the Western world. So, it catches up and leaps, it pulls back, but it still basically keeps its pace with the degradation of the money unit. Don't look at it week to week. But we think this next move in gold will be associated with other major fractures in other markets, like the breaking of the stock bubble that's been going on a dozen years now. We also think that the T-bond market, which gold is linked to right now, technically, whereas if bonds rally, yields drop, gold has been moving with it, tends to, on a month-to-month basis, not day-to-day. But we distrust the bond rally, ultimately and lasting. We think it's good for, maybe another couple months. We've got some overhead numbers that are likely to be reached, which haven't been reached yet. But we don't think that is an alternative to gold, which it's been, over the last year or so. It's been a par with gold in terms of a place to hide, okay? We don't think it's going to continue to be. We think bonds will top after this next rally and likely enter a bear trend. And I'm talking the U.S., German, and Japanese government bonds as well. They're all long-term set for major declines after this rally is over. So that if that occurs, that will further narrow what you could call the alternative market for those who need to put their money somewhere else to protect the value of their money. Okay. T-bonds are okay right now. They're safe, guaranteed by the government. But there's a point at which that market's going to reflect the inflation. And it's going to top and go back down. And technically, we could see that coming, but not right now. We think it's going to rally probably along the first phase of a market decline and along with this rise in gold. But beyond that, beyond this year, I think gold and silver may be fairly isolated. Commodities will be firm, but they won't match gold, just like in 1980 they did. Commodities exploded from the late 70s. We all know that. Stagflation. But gold still led that move. And we think that'll still be the case. But we think gold and silver could move in a more parabolic fashion. Not so incremental, not so gentlemanly, where you have time to think about it. And we think coming out of this recent 1 year wide congestion zone in silver and this corrective move in gold, coming out of those zones, and we think we're close to doing that, will change the tempering tone.
So, Michael, as you're just mentioning this relationship between, let's say, gold and bonds here, there's these traditional relationships that seem to move inversely or together, right? Take real rates, for example, or the dollar. So, can you tell us if you look at any of those relationships, and are some of them starting to basically behave normally or traditionally again? I notice these relationships, and a lot of people like gold bugs get real nervous about the idea of the stock market going down, because all they remember is last March, okay, and or they remember October of 2008, when finally at the tail end gold did join in with the stock market. But during those years, the gold was actually in sync with the stock market. From early 2000s up to 2011, the stock market was going up along with gold. And gold outperformed up through 2011 and then went down totally opposite the stock market. From 2011 through 16, the stock market was going up. But a lot of these relationships, they hold water if you look back a year or two. But if you really go back 50 years, they just don't, they're not constants. The one major constant, is if you destroy the money unit over time, gold's going to keep going up. Because it's money. It's real money. You can't destroy it. You can't inflate it. So despite the ebbs and flows of money growth, let's say, gold's going to offset that, because it's a constant trend toward monetary degradation in the West, especially now that we're hyper monetary degradation. And so gold's not going to go into a bear market if they're going to continue to degrade money units, especially anywhere near the pace they've been. And they can't stop because of the reasons we talked about. And if those reasons didn't occur, like a stock market decline first, if they did that, the stock market would decline. So in which case they'd have to stop. So either way, the background for gold, the real relationship is the degradation of the money unit ongoing is occurring. If it weren't occurring, that'd be a different issue, but it's occurring now, at lightning speed. So when we're talking about this degradation of the money or the monetary unit, of course, we're speaking about inflation, right? So monetary inflation. So will that trend, is that going to keep affecting commodities? We've seen a consolidation in, for example, lumber and steel here recently. But is that just a consolidation before their next move higher as well?
I think lumber and steel can be exempted. They had major moves, but in part that was due to one of those social things we talk about, and I think this was an event caused by wealthy people living in large metropolitan areas who run corporations, have their family in nice townhouse apartments and high-rise buildings, who suddenly had a sense of being unsafe. They couldn't pin it down, but they just had a sense, we need to move. And money wasn't an issue for them. They're just getting out of there. The wife said, "No, I just walked down the street and I saw something happen." Okay, so what did they do? They moved to the suburbs near the city. But the problem was the housing market there wasn't enough available, especially at their level. So what did they do? They built it out of the blue, and they didn't care about prices. So you caught the lumber mills off guard, because we were in a slump at that time, back in March of a year ago, where lumber mills weren't pumping it out because the demand wasn't that good. So all of a sudden there was a shortage. You took lumber off the page, you took steel rebar off the page. I think both have topped. Lumber's collapsed. In fact, it was 1,700 near the top week, and we said this is probably the top. Sure enough, it was. We're now at 600, and that's a rally. Okay, we think lumber and steel are exceptions. to the overall commodity upturn. Look instead at the Bloomberg, and in fact, lumber isn't even in the Bloomberg index.
Interesting.
Okay. Look at the grains, look at oil, especially look at natural gas. We think natural gas could be one of the strongest commodities out there. It's now above $4. It wouldn't shock if it went to $9. We've got some trigger numbers above that'll dictate that in our reports, and they're not far above. But it occurred simultaneously, not last March, April, and May. It occurred in November, when most of these commodities clicked into gear, broke through quarterly momentum and annual, coincident with the Bloomberg Commodity Index. So it wasn't specific to the market. Mm-hmm. Lumber had a specific. Steel had a specific. Coffee recently had a specific. They actually had a crop problem. But most of these upturns in commodities weren't based on some specific headline news story. It was in general an asset class shift by investors moving money into a cheap category. Commodity prices weren't going to go any lower. They laid there from 2016 through 2020. They basically laid there at levels they just said, we're just not going any lower. It's just an issue. When do we turn up? And then when they had a quick downside spike in early March, some commodities did, and then they blew out of the hole. And it just began, literally began months ago, not years ago. So when we look at the long-term momentum on commodities, we see at the beginning of something, yes, you can have a correction, but it's a correction in a new bull market. It's not a top. Lumber and steel, different story. They may have seen their highs. Mm-hmm. But the broader commodity complex, we think, is basically in the same position it was in the late 70s. It was just an asset class preference shift.
One of the last let's say classes that I want to ask you about, Michael, is the dollar. How is momentum developing in the dollar right now, and what key levels are you looking at?
It's also right. We turned bearish in 2017 in May. The dollar had hit a high. First of all, we were bullish from 2012 through 2015. The dollar was around 80. We thought it would go to 100. It went to 100. Finally went to $103.80, I think it was, in early 2017. It was in a range from 15 through 17. It popped up out of that range, went to 103 plus dollar index, we're speaking of now. When it dropped back down to 99, we turned massively bearish. It then dropped, this is May of 17, it then dropped down into the high 80s, like to around 89. Now, that's a very important level. Mm-hmm. You go back and look historically, but the last 10 years, you'll see that's a pivotal level on a price chart. Mm-hmm. It was old highs, and it became a low. Then we rallied up in 2018 and 19, back up into the upper 90s. And there was a brief spike March last year when there was that panic, stock market panic. There was a rush to own dollars because certain instruments needed to be bought. That lasted a few days, and it peaked and collapsed all the way back down early this year, where? To the upper 89s again, back to 90, as it's called. This year has been stuck in a range from 90 to 93. It's like it's dead. Mm-hmm. People look at these rallies in this range, and it's almost meaningless. You have to get a microscope to see it when you look at a 20-year chart. Mm-hmm. The dollar has had two massive bear waves since the 1980. It was like 128 or something. We've begun our third wave down, and we think it's going to take it well below 70. It's now been trading either side of 92. If you trade down below 91 this month by much, we're going to break its monthly momentum into a bear trend. It's been in a positive trend since late last year. And all that's done for price is stabilize. Mm-hmm. Hasn't really been able to exploit that breathing period in momentum, which has allowed it to rally, but it has really not been able to rally much. If you go back down, you ever touch 90 again, it's really over. But we've got some trigger numbers below 91 that if we get there this month, you're probably on your way down to below this floor that you can see on a price chart. Get a dollar index chart, go back to the 10, 12 years, and you'll see that this is a balance point that they've been hugging all this year, not bouncing off of it, just hugging it. Okay, so really a deflated look and tone. Mm-hmm. And we think the dollar will then contribute, suddenly become a player again. And right now it's been the quietest market on the board. Inverse that to the euro. It's been quiet as well on a percent basis. Right. And we think if Forex, the major Forex, the dollar and the euro get volatile again, all of a sudden there's a new variable out there that will have wave effects.
So, Michael, one of the final questions I'd like to ask you, something you did mention here today was, when you talk about chaos theory, what are you referring to, and what do you mean there?
Well, most trends we're used to, they tend to go in a nice zigzag pattern where you draw an uptrend, and or they're in a downtrend. Normal bear markets, normal bull markets. But chaos theory is when the market wants to go to A to Z, and it goes from A to M in an incremental manner, and then just says, "Oh, I give up," and it just goes to Z. It just does it all of a sudden, and it's pent up demand, and it's probably, like I said, there's other asset categories, but if these other asset categories, which have siphoned that river flow of capital that central banks have created, they've gone into the stock market and into supporting government bond markets. You look at the JGB, the Bunds, and U.S. 10-year notes, they have like a floor under them. So they've been supported too by this monetary inflation. But if all of a sudden these major categories become disturbed and the Fed isn't in charge anymore and their prices start to go negative, that leaves you with all this money looking for a place to go. And all of a sudden now there's not 5 places or 3 or 2. There may only be one, and that be monetary metals and associated miners. And I think we're setting up a situation where that could occur. And that's why you look out your side mirror at that stock market, because that's where most of the money has gone over the last dozen years.
Well, Michael, that's I think a great place to wrap up on. Do you have anything else you'd like to add here before we finish up?
No, just my focus now would be on that NASDAQ annual momentum. Mm-hmm. In fact, I think you could throw all your other charts away. You could take that NASDAQ annual momentum chart, that gold quarterly oscillator, plotted in weekly format, and that silver 40-week oscillator. Take those 3 charts. If you see that NASDAQ aboard back through that ceiling, back down to where it's 40% above its rising 36-month average, check it off. It's over. Gold goes up above that level. It's several percent above where we are now. That's all. And silver goes up a couple bucks. I think the game changes. We're back in gear again, and the volatility is coming back. All of the charts, forget about them.
Well, that's the top 3 right now that are most important, right?
I think so.
Yeah. Excellent, Oliver. Michael, of course, you're available at Oliver_MSA on Twitter. You guys post some stuff there, as well as olivermsa.com. Anywhere else you'd like to point people to?
No, just to send us an email, and we'd be happy to send you sample reports and so forth. We have several subscriptions. Our regular covers all 4 asset categories. That's debt, foreign exchange, commodities, including gold, silver, and the stock markets. The other one is just gold, silver, and miners. Well, it usually comes out once a week. The other one comes out about every day, the all asset category, 5 or 6 reports a week. It's more expensive. And we also have a Bitcoin report. It comes out every 2 weeks, bi-weekly. And it just focuses on Bitcoin and Ethereum futures. Anyway, thanks for listening.
Thank you, Michael. I really appreciate it. Really appreciate your time and your perspective.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.